And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani. And you know, when it comes to dealing with the Russell 2000 reconstitution and the Russell 1000 reconstitution, along with the ETFs associated with that, this is a very, very big week. This is the year this is going to happen. This is the week it's going to happen. Let's talk to one of the women in charge of all of that. Fiona Bassett is CEO of FTSE Russell, one of the largest indexing firms in the world, owner of the small cap benchmark Russell 2000 and large cap Russell 1000. Also joining us is Todd Rosenbluth, head of research at Verify. Fiona, the reconstitution, as we like to call it for the FTSE, is going to be happening this Friday. It'll be one of the highest volume days of the year. I've seen estimates we could have 135 billion in equities trading on the close. There's stocks moving from the Russell 2000, the small cap, to the Russell 1000, the big cap, also vice versa. Briefly, for viewers who aren't familiar with this, explain how this process works.
Yeah, so thanks, Bob. Great to be here. So, yeah, hugely important event in the Russell calendar. So, as one of the leading US equity benchmarks, we annually reconstitute or rebalance the index. What we do on a rank date on the 30th of April is we basically score the companies by market cap. We look at the eligibility of companies for inclusion in the index. We look at their respective characteristics from a growth and value perspective. And then on the 24th of May, we start preliminary announcements of the additions and deletions to the index. And that process runs for a 4-week period, concluding this Friday on the close. Yeah,
so what we see here is there's several tech names that had a very strong year, and they're moving up from the Russell 2000 to the 1000. I see Super Microcomputer is going from the 2000 to the 1000. That's what, up 600% in the last year. MicroStrategy I see is going into the Russell 1000. That's up 270%. It's easy to see. So it seems like technology are the ones that are moving up.
Yeah, it's certainly the story for Russell 1000, which is being replenished by technology, and the overall direction of which I think speaks to the re-engineering of the US economy around technology. So interestingly, the Russell 2000 is much more of a healthcare story. So very different story depending on whether you're looking at large or small caps.
Yeah. Todd, let me bring you in here. You know this argument about passive investing. As passive investing has gathered more assets, old school stock pickers have complained that passive investing is taking up too much of the investment dollars, and some have implied that just mechanically putting money into big cap indexes like the Russell 1000 or the S&P 500 is reducing the effectiveness of other strategies like value investing. How do you respond to those criticisms?
Well, I think we're seeing stocks moving day to day, regardless of whether or not something is making it into the index. So the Russell 1000 and the Russell 2000 and those respective ETFs are important to focus on. But we at Verify are focusing on the growth and the value slices of those respective benchmarks. And so, for example, Home Depot is now going to be part of the value, the iShares Russell 1000 value ETF. Accenture is moving from the growth to the value. These companies are moving from one to the other because the index calculations show these are now value-oriented companies. There's still opportunities for active managers to outperform a benchmark by choosing which stocks are going to be more growth-oriented or more value-oriented, or overweighting or underweighting that exposure. So that hasn't changed, and we continue to find active managers having some success competing with the benchmarks.
And yet, is there a reason, how do you feel about this whole argument? We've had value managers come on and say, I don't know why, but for some reason value is not working. I've been a famous value manager for many years. I used to do very well, and suddenly I'm not doing very well. Some of them sound like they're complaining that, well, I don't know why, because I made a lot of money before. Why aren't I making a lot of money now? There must be something wrong with the market. It can't be my methodology. It's got to be this something. And they usually point to all these passive investors. They're buying big cap indexes like the Russell 1000 passively, on the S&P 500 passively, and it's changing the metrics, the calculus. There's not enough value investors to buy these stocks cheap and then move them up later on. Is there any validity to these arguments? They're very persistent, these people.
They're persistent. The research doesn't tend to validate it. I will say the rise of index investing is really driven by the solution that it brings to clients for transparency, low cost diversification. Clearly, I think from a structural perspective from the economy, the story has been one of growth driven by technology, particularly in the large cap space. Interestingly, out of the top 10 in the Russell 1000, just one of those is a value stock with Berkshire Hathaway. But clearly there is a question of, is there the limit to the tech-led expansion story, and over the long term, mean reversion, I think will be an interesting potential for the rise of value managers.
Yeah. How do you feel about it, Todd? I mean, we've seen a persistent underperformance for the last, almost 15 years of small cap versus large cap. And you can see that with the Russell 1000 and the 2000 indexes. I don't know, look, just year to date, the Russell 1000's up 14%, the 2000's flat, essentially. And again, growth is outperforming value here. We keep waiting for mean reversion. I mean, our understanding has always been there's mean reversion, long-term small cap outperforms big cap, value outperforms growth, but that hasn't happened for a long time.
You're right. I mean, we still think that we're going to see a mega cap growth oriented market based on what we're hearing from advisors. They're leaning towards quality, they're leaning towards growth heading into the second half and not into value. Small cap has underperformed. I do think the environment is going to shift when the Fed begins cutting interest rates. We've been waiting for that to happen the first half of the year. No interest rate cuts, as you know, and the audience knows. If and when we have that coming up in the third quarter, that should likely signal an opportunity for small cap strategies to do better. The Russell 2000 based strategies, the S&P 600 based strategies, and some of those smart beta strategies that are tied to it. So we could see a stronger second half for small caps, but I still think growth is going to outperform value based on the sentiment we're hearing from advisors.
Yeah. So Todd, what accounts for this persistent outperformance on big cap growth here? I mean, we were talking with Fiona about this. Some want to blame passive investing. You study this very carefully. Is that an issue, or is there some other problem going on here?
Well, I think NVIDIA has been driving the stock market in 2024. I don't think that's a passive approach. There are active stock pickers, both individual investors, professional managers, that are betting on NVIDIA's continued growth tied to artificial intelligence. So that has not been tied to ETFs. We've seen money going into broad market-based, market cap-weighted strategies tied to the S&P 500 and other strategies thus far this year. NVIDIA is driving the market higher. It's not that money is flowing in to one stock in particular, because we've seen a performance disparity between the Mag 7 stocks. They all were going up in 2023. They have not all continued in 2024, even though money has gone in to the Vanguard 500 ETF. So active stock picking is still driving the market, just not everybody's having success.
Yeah. You know what amazes me, Fiona, how the small cap market is small and sort of getting smaller relative to the big cap market. So I'm looking at the Russell 1000. This is your data, $50 trillion market cap right now. The Russell 2000 stocks, not 1,000, has $2.9 trillion in market cap. I mean, it's 1/16th the Russell 2000, the size of the Russell 1000, with twice as many stocks in it. The 10 largest companies in the Russell 1000 are 30% of the Russell 1000, so about 15 trillion of the market cap. So the big essentially keep getting bigger, you know, and it's rather remarkable. And it's not just tech. Even, you know, some of these indexes, you know, Exxon dominates energy indexes, for example. Amazon dominates consumer discretionary indexes, and Alphabet dominates, you know, I guess you'd call it communication services indexes. So the big keep getting bigger. So the value guys do have a certain point here, that money just keeps going into these areas here.
Well, I mean, the indices just reflect the nature of the market, right? And the reality is that in many of the sectors, there's a concentration in that of between the winners and the losers. So it's interesting you mentioned Russell 2000. Actually, the threshold for the breakpoint from small to large caps has actually increased to 4.6 billion, which is a rise of nearly 10%. So there is an underlying dynamic there. But clearly, I think one of the benefits of the Russell franchise generally is our ability to provide different sleeves of exposure. So for those of people who want to get a concentrated exposure to value or to growth, we have the indices available to do that.
Yeah, and it's the same way with not just size, with big cap getting bigger and bigger, But it's the same with growth. All the money is going into growth. So look at these numbers: $98 billion in assets under management in the Russell Growth. This is the ETF here for this, and $56 billion in the Russell 1000 Value. And again, I know you're an index provider, you're sort of agnostic on all this, but it's quite remarkable to see the money, the size of it that keeps going in. Todd, same thing here. So again, larger companies keep getting bigger, and growth companies continue to keep getting more money into them. Would it take a dot-com thing? Or would it take, we're certainly not in a dot-com atmosphere, would it take a financial crisis to change that at all? I'm just curious about, we've been waiting for 15 years for something to happen here, mean reversion, and it's just not happening.
Well, we have seen periods when value outperformed growth. So it feels like a long time that growth has outperformed value, but there have been periods when the pendulum has swung back in favor of value. And so you showed about $56 billion in that iShares Russell 1000 Value ETF. That's still a lot of money that is being impacted by these rebalance that's taking place next week of new companies coming in, companies moving to the growth, companies moving into the small cap space. So I do think it's worth paying attention to value, but money has stayed in growth, and it's up 20%. I think the iShares Russell 1000 Growth ETF is up 20% this year. So the assets under management continues to climb higher. We do think there's a place for both growth and value within a broader portfolio. Just people are skewed more towards growth heading into the second half of the year.
Russell has a lot of different indexes besides the 1000 and the 2000. You have ESG ETFs, environmental social governance ETFs. We've seen a whole big debate about this in the last couple of years. It's got somewhat politicized, frankly, which I find rather depressing. But how is that affecting flows at all? And any thoughts about, I know FTSE Russell has a series of ESG ETFs.
Yeah, so I think it's interesting because there's so much opportunity for growth in the index space generally, and you've seen that actually if you look at the development of fixed income ETFs, more recently obviously the rise of sustainable ETFs, and a much more nascent stage in its development around tokenization. So our role as an index provider is obviously to make sure that we're providing the toolkit for our clients to navigate what is a complex world of change and risk parameters. So yes, we do have a range of sustainable ETFs. I think the dialogue around that, as you rightly point out, has been somewhat politicized in some quarters. I would say nonetheless though that we are seeing particularly a focus from our clients around climate transition and how indices can actually help manage that.
Yeah, I hope this argument, this debate would evolve a little bit. I've had a lot of intellectual issues with ESG. It's sort of an odd bolting together, environmental, social, and governance, just bolting them into one product. I've had problems with the fact that some of this is qualitatively, a lot of this is qualitative. It's difficult to get quantitative with it, which is what you need to do. But those are intellectual differences, and to watch it become politicized is rather unfortunate. Hopefully, I would hope that you will get some new movement in this space where people will sort of move on. I don't think people are necessarily opposed to diversity in the boardroom, for example. That seems like a non-controversial issue, it would seem to me, and certainly people don't want more pollution out there, and yet these things get politicized. It's remarkable to me. You know.
It is, but I think the debate is also evolving, and frankly, we're seeing a lot of the discussion actually now move from a broader ESG lens actually around climate and the transition and the decarbonisation and the path to do that. And so I think it's also a process of whenever you get a new area, particularly where the data is evolving, regulations are evolving, it just to me speaks to the need for actually a lot of education, and clearly that's a role that we really take that as a serious responsibility of ours, not just in the context of sustainable but more broadly, because I still think even though we celebrate 40 years of the Russell franchise this year, I still think we're early in the overall development of the industry.
Yeah. I want to ask you about how FTSE classifies countries. So, for example, Vanguard is the emerging markets ETFs, is a VWO, and they use your FTSE emerging market index. South Korea is not in that, and iShares emerging market, the EEM, does have South Korea, and so this has sort of been a debate for a long time about the politics of indexing, what goes where, particularly in emerging markets. South Korea is part of the developed markets ETF, the VEA, for example. So can you explain how that works? How do you determine what's emerging markets versus what's developed markets?
Yeah, so I think one of the distinguishing characteristics of FTSE actually is our governance structure and our overall approach from a policy perspective. So we actually, as well as having an in-depth policy team and research team, we actually have outside advisory committees that are constituted from representations across the index ecosystem that then feed into our thinking and classification. So we have a kind of robust methodology around it. As you say, there are differences between us and other index providers. I think personally that's what makes indexing interesting.
Yeah, it is a little bit of an art, Todd, right? I mean, it's an interesting question. Is South Korea a developed or an emerging market at this point? And there's other ones that come out there too as well. And what's important is because South Korea is so big, it affects the performance of the ETF. And so you have to be cognizant of the fact that a decision like that is made. And when you're buying an ETF, this goes to what you and I talked about many times, looking under the hood of what these ETFs are. Owning South Korea in an emerging market fund or not owning it will produce different outcomes. And so you have to be aware of that. This is where it gets tricky with this ETF selection process.
You're right. So it's up to the investor to make sure they do their homework and look inside the portfolio to understand what they're getting and what they're not getting. But equally as important, you would be missing out on South Korea if you bought the iShares Developed Market International Equity ETF and the Vanguard Emerging Markets one, because they're two different index providers with two different classifications. So it goes back to understanding what's inside the fund, making sure people do that. I agree with Fiona. It's what makes it interesting, but it also makes it a challenge for folks who are trying to click the easy button and just buy the cheapest ETF without doing that extra homework.
Yeah, it's part of the question you want to do, and most people don't get the high-level intellectual skills that you need to do this. I mean, most people want to buy the S&P 500, and they do it. So there's a sort of a level of complexity here that's added when you have to make a decision like that. I think I'm not sure myself whether I would classify South Korea as an emerging market or as a developed country. I think it has characteristics of both, so it's a tough call.
Yeah, and it's why we spend so much time actually in education and working with our clients on some of those issues.
Yeah, no, different one. All right, fascinating discussion. Thank you both very much. That does it for this week's ETF Edge. My thanks to Fiona and to Todd. We've asked Todd to stick around to provide us some additional perspective on ETF trends for the ETF Edge podcast that's coming up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.